You might think that keeping your cash in the bank is the safest and smartest way to store your wealth. After all, banks are supposed to protect your money from theft, inflation, and market crashes, right? The truth is, keeping your cash in the bank exposes you to a lot of risks that could erode your purchasing power, reduce your returns, and even wipe out your savings. Here are some of the dangers of holding too much cash in the bank. 1. Inflation. The average annual inflation rate has historically hovered around 3% in the US and many other developed countries, which means that every year, your money loses 3% of its value. That might not sound like much, but over time, it adds up. For example, if you had $100,000 in January 2000, it would have the same buying power as $152,099.63 in July 2021. 2. Fees. Banks charge fees for various services such as monthly maintenance, overdrafts, ATM withdrawals, wire transfers, and foreign transactions. These fees can eat into your interest earnings and even your principal amount. For example, if you have a savings account that pays 0.5% interest per year, but charges $10 per month in fees, you would end up losing $120 per year instead of earning $500. 3. Low returns. Speaking of interest earnings, most bank accounts offer very low returns compared to other investment options. The average interest rate for savings accounts in the US is 0.42%, which is barely enough to keep up with inflation. Even the best high-yield savings accounts only offer interest rates of up to 5.25% annual percentage yield, which is still far below the historical average return of the stock market, which is 10%. 4. Bail-ins. In the event of a financial crisis or a bank failure, your deposits could be used to bail out the bank. This means that instead of getting your money back, you could get shares of the bank for nothing at all. This happened in Cyprus in 2013, when depositors lost up to 60% of their savings. So what can you do to protect and grow your wealth? The answer is to diversify your portfolio with alternative investments. Alternative investments are any assets that are not stocks, bonds, or cash. They include things like: Number 1. Real estate. Real estate is one of the most popular and profitable alternative investments. You can buy properties and rent them out for passive income, flip them for capital gains, or invest in real estate investment trusts, REITs, for dividends. Real estate also tends to appreciate over time and hedge against inflation. Number 2. Cryptocurrencies. Cryptocurrencies are digital currencies that operate on decentralized networks using cryptography. They offer high returns, low fees, and global access. Some of the most well-known cryptocurrencies are Bitcoin, Ethereum, and Litecoin. Cryptocurrencies are also very volatile and risky, so you should only invest what you can afford to lose. Number 3. Commodities. Commodities are raw materials that are traded on exchanges or markets. They include things like gold, silver, oil, natural gas, coffee, sugar, and wheat. Commodities can provide diversification, inflation protection, and growth potential. Number 4. Art and antiques. Art and antiques are collectibles that have artistic or historical value. They can appreciate over time and offer aesthetic enjoyment. However, they also have high transaction costs, storage costs, and liquidity risks. Number 5. Private equity or venture capital. Private equity or venture capital is investing in private companies that are not listed on public exchanges. You can invest directly in startups or established businesses or through funds or platforms that pool money from multiple investors. Private equity or venture capital can offer high returns and access to innovative industries. Number 6. Hedge funds. Hedge funds are pooled investment vehicles that use various strategies to generate returns regardless of market conditions. They can invest in any asset class and use leverage, derivatives, short selling, and arbitrage techniques. Hedge funds can offer diversification, risk management, and alpha generation. Number 7. Managed futures. Managed futures are funds that trade futures contracts on commodities, currencies, interest rates, and indices. They can profit from both rising and falling markets and use trend following or contrarian strategies. Managed futures can offer diversification, non-correlation, and downside protection. Number 8. NFTs. NFTs are non-fungible tokens that represent unique digital assets on a blockchain. They can be anything from art, music, games, sports, memes, to domain names. NFTs can offer ownership, scarcity, and creativity.